Welcome back to the LPR Trading Group YouTube channel. It's Dave again. Sorry it's taken so long to get this third module out. I went through a minor surgery. I've recovered. Everything is good. And we're back at it. So let's start with module 3 of this understanding market concepts and market profiles here. So module 3, we're going to be talking about normalities and anomalies in the market profile. So we'll start with excess and responsiveness. Excess is when the market leaves a tail at a higher low of the profile, 2 TPO prints or more, indicating responsiveness from other time frame participants. So oftentimes you'll look at your market profiles and you'll see on the profiles you will get these tails at the bottom of the profiles here, and they could be large, just like this one here, which would equal responsive buying in A period. So if A period is our first period, as you guys know, I split my periods here. So if A period is period 1, we have responsive buying off open price, driving price to the upside. To me, it is critical to look for responsiveness on the bottom side of a profile if I'm looking for long trades, or responsiveness on the top side of a profile if I'm looking for short trades. Excess is important when we're looking at market profiles because this represents a clean and complete auction. We do know auctions like to drive up and drive down. Now, if we have an auction that is driving up and the auction is constantly making these relatively equal highs, this is an incomplete auction, okay? There are participants willing to offer higher eventually and bid prices higher. So we're looking for the sweep of the high, which will create excess, either at least 2 TPO prints or more, and then either a potential reversal or acceptance above the current auction here. It is important not to participate or not to anticipate excess, but to use it in context with previous market profiles or previous market profile periods. Example, we have a poor high or a poor low from the previous day's profile. We can assume with some certainty that the market is going to revisit that poor high or low and clean up the auction. Once the market trades above or below that poor high or low, we must judge the auction and participation or lack thereof. This is where the footprints come into play for me. So for example, we'll chat about poor highs and poor lows on the next slide, and I will go into that. But essentially a poor high or a poor low is when 2 periods do not create excess at the high or the low of a profile. So you can see on this profile right here, we've got 2 periods, which would be C and D period, creating equal highs. This is a poor high, okay? And what a poor high means is there is liquidity or fishy stops remaining above this poor high that the market will eventually look to attack to clean the auction up. This is an anomaly in the marketplace. If price is accepted outside of this poor high or poor low, we can look to trade with the current direction. If acceptance fails, we can look to fade this direction. So it's very simple. If price came back above this poor high and we failed to auction higher and we left an excess tail but began to trade back below the poor high, we could possibly look to fade this move. If the market trades above this poor high, so right here on these prints, if the market trades above this poor high, we'll draw this straight across for you guys. We drive up, we test back under, we reclaim, and we're holding this poor high. We're looking for a directional move with the poor high break. We're accepting price outside of that range. Now, if you think about this like a vehicle auction, for example, I've used this example before in some videos, but we'll go over it now. You go to a vehicle auction and a vehicle pulls out and the starting price is $10,000, okay? The auctioneer calls for $10,500 and a few people come in, or one person comes in and says, I'm willing to buy this car at $10,500. He then lifts the offer to $11,000 and he wants to see if anyone wants this vehicle for $11,000. He gets a bid at $11,000. The next price is $11,500. As soon as he gets the $11,500 bid, he instantly sells the car. This is an incomplete auction because there might have been other participants participating in this market auction that wanted this vehicle and were willing to pay higher prices. He gave the going once, going twice, going once, going twice, as soon as he saw the 11,500, he hit the hammer on the table and sold the vehicle. This is an incomplete auction. This is essentially what happens on a poor high, or how you can think of a poor high. The auction is incomplete. There are disgruntled buyers here that were willing to pay $12,000, $12,500 for the car, but the auctioneer didn't give enough time for anyone to actually raise their bid and bid higher. Okay? That's what happens here, or that's how you can think of this poor high. As soon as we get rejected here, you can think of participants wanting to or willing to aggressively buy and passively sell above these areas. So the market is supposed to come up into these areas and clean up those poor auction levels. Like this and like this. Poor highs and poor lows. Let's jump to the next slide here. And this is where we'll talk about poor highs and poor lows. Poor highs and poor lows are incomplete auctions in the marketplace. These areas provide liquidity for bigger players inside the marketplace. They act like magnets for price. These areas do not have to be resolved on the same day or the next day. What I like to do with poor highs and poor lows is I like to mark them out on my chart, and I like to leave them on my chart until they get resolved. This could be a few days later or even a week or two later. If these poor highs and poor lows go on for months and months and months, likely some other price action has developed that I will trade as a day trader. I'm not very interested in poor highs and poor lows that happened 2 or 3 months ago. But if they happen within the past few days or even past few weeks, I will definitely keep them on my chart and keep them in mind. Poor highs and lows make better targets than trade entries. If we're anticipating the market is going to run for a poor high like this, and we have a period opens here, a period actually dips all the way down, and then we drive back up through the open price here, we could look to find an entry somewhere on A period or B period, looking at our footprints obviously, our levels and our intraday price action, to target this poor high that was put in here. Now you can see in this case, we drive up, we sweep the poor high. In D period, we put in 3 single print periods here, 1, 2, 3. That creates excess in the auction or excess in the marketplace. We've swept through the poor high, we drive up, fail to accept, and then we trade lower, okay? So this is an instance or a situation where we actually break the poor high, find the liquidity, turn around, and trade lower. Okay guys, we'll leave it at that for this module, Module 3. Look forward for Module 4 in the next coming days. And as always, like, comment, subscribe. Leave all your comments down below. I will get back to every single one of them. Cheers, guys.